Hello and welcome to Portfolio Matters Week 88 Weekly Update. Before I get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have financial interest in. Please do your own research or consult a professional investment advisor for making any decisions regarding topics mentioned on the show. The full disclaimer can be found at the end. Okay, so last Friday we did the normal weekly, but we mainly concentrated on the UK and left out all the usual checklists and economic updates. So I'm going to be doing a short weekly today covering those topics. Unfortunately, it's Wednesday, so Richard is working and Stuart is playing tennis. Lazy sod. Anyway, so first of all, the news. Well, Russia has now cut off gas supplies to Italy. OPEC Plus are meeting to discuss cutting production by between 1 and 2 million barrels a day to support oil prices as the world economy slows. So that is in direct contravention of the pleas of the Biden administration to increase output, to lower oil prices and support economic growth. And that is a sign of declining US influence in the world. The UN Conference on Trade and Development called for central banks around the world to stop raising interest rates and for debt relief for poorer countries, as high US rates really starts to hurt emerging markets. And we have had a series of crises around the world. Sri Lanka comes to mind. And as the US continues to raise rates, that will continue to put stress on emerging markets, and we expect more trouble ahead. Now, after the chaos in UK financial markets last week, some UK property funds have gated themselves and halted withdrawals as pension funds have rushed to increase their liquidity. Kwasi Kwarteng has U-turned on part of his mini budget and will no longer cut higher rate taxes. However, the shock to financial markets caused by the mini budget has not faded, certainly in the form of gilt yields, which remain elevated. We will show you the data. But the main news of the week has been a very strong rally in risk markets, which appears to be fading now on Wednesday morning, and which I very much believe was just the usual bear market rally stuff. Okay, so this is the UN Conference on Trade and Development, which has called for increased debt relief and a halt to interest rate rises. I doubt very much that they will be influencing the Fed. So OPEC Plus are meeting to discuss production cuts. We know that world inventory levels are already below average, and Goldman Sachs are forecasting that if they cut production further, then inventories will get even worse despite a slowing world economy. Now, OPEC once again have pricing power. Saudi Arabia has a policy of supporting the market when it is the swing producer. So during the shale boom, it did not cut its production because it knew that any cut in its own production would be more than made up for by increased production from US shale. But now the US shale revolution is fading. Saudi Arabia once more has power as the swing producer, and this is its first use of it. So it is showing that it is back in charge of the oil market. That is good for oil prices, but bad for the world economy. In shades of the financial crisis, some UK property funds have limited withdrawals, as they have run out of liquidity. Okay, on to this week's economic data. So it's only been 3 days since the last update, so there's a limited range of new data, and I will go through all of it. So first of all, we had Chinese PMIs. So the manufacturing PMI beat expectations. It was expected at 49.8 in September. It came in slightly above that at 50.1, so just above expansion. The non-manufacturing PMI missed expectations, and by a margin. So it was expected at 52.8, it came in at 50.6. So again, just slightly in expansion territory. So overall, the general PMI came in below expectations at 51.7. So it's showing that the Chinese economy is growing, but only just. In the EU, we had inflation numbers, and they both showed that inflation was still rising. So CPI came in at 10% for September, beating expectations, and a big rise on August. Core CPI came in at 4.8%, again beating expectations, and again a big rise on August. We then had manufacturing PMIs for the US. Now, the headline PMI missed expectations. It was expected at 52.9 in September. It came in at 50.9. So that's quite a big miss and well down on August. The prices paid beat expectations. So that's disappointing, showing that pricing pressures in the US are persistent. The new orders was the most significant piece of data, and that again was disappointing. So it was expected at 51.8. It missed heavily, coming in at 47.1. And manufacturing employment also dipped sharply to 48.7. But the big news of the week was the JOLTS job openings. Now, they massively missed for August. They're expected at 11.1, and they came in at 10.05 million. So there is a big drop in August of US job openings. However, the quit rate beat expectations and remains elevated. And the bottom line about US job openings is, yes, they've fallen sharply, but there are still 1.7 job openings to each unemployed person. So the US labor market remains tight. Okay, onto the charts. So this is Chinese manufacturing PMI, and it's just above 50. The non-manufacturing PMI is fading, as is the general. This is EU inflation, which looks like a straight line up and shows no sign of stopping. Core CPI, again, still shooting up at quite a pace. But the EU unemployment rate is at its lowest level in 25 years. This is US manufacturing PMIs, and that is not a happy looking chart. Manufacturing sector in the US is slowing. New orders have fallen below 50 and are in contraction territory. Employment fallen below 50, again, contraction territory. Now the JOLTS job openings fell very sharply, although the quits rate bounced slightly. So more people are quitting their jobs for other jobs, and that supports wage growth because people leave for higher paid jobs. But when we look at the JOLTS job openings report, the green line here is job openings. As you've seen, it's fallen to 10.1 million, but the job openings per unemployed person only fell to 1.67. So there are still far more jobs than there are unemployed people to fill them. So that suggests wage pressures will remain, and the Fed cannot afford to slow on its rate rises. So this is the US Mortgage Brokers Association 30-year mortgage rate, and it continues to rise, and that is very bad for the US housing market. As we've said many times, the housing cycle is the business cycle, and this will cause the housing cycle to slow. So in summary, US manufacturing PMIs for September point to a continued slowdown in the US economy. It is still just in expansion territory, but it's slowing fast. The job openings dropped more than expected, but the labor markets in the US remain very tight. EU inflation continues to rise, and the ECB will therefore have to continue raising rates. Okay, on to one chart. Now, this is a great chart. So, what it shows is the ratio of reported S&P 500 earnings to the earnings reported in the national accounts of the US. And what that means is how creative have US companies been in massaging their numbers. And you'll see that the red line oscillates around 100. So it's strongly mean reversionary. In the good times, companies try and massage their numbers up, but then during recession, they try and get them down as much as possible. So in the next cycle, they can get back to beating the consensus regularly. And right now, the number is elevated and at a point where some mean reversion could be expected. So in summary, corporate profits seem artificially high and are likely to fall. I hope you've all now watched my short piece on the Kalecki-Levy formula, which relates fiscal deficits to corporate earnings, and the fiscal deficit is falling, and therefore corporate earnings should also fall. So there's a lot of forces pushing US corporate earnings down in the coming year. Okay, on to the weekly funny. And Richard B., if you're out there, I hope you appreciated my nice picture of the Lake District as our cover photo this week. Although the UK is going through a spasm of political stupidity, it remains a very nice place to live for most people. And on to Inflation Watch. So we had EU inflation figures, and really not reassuring. There's strong rises from August in both the September numbers, and German inflation was also strong. European inflation continues to rise. Now, in the US, the reason that inflation is strong and persistent is essentially that the US government overdid the pandemic stimulus. And so what you see here is the US savings rate. And during the pandemic, US households saved a lot of money. And although the savings rate is now down below historic norms, all this excess savings remains in household bank balances to be spent. And so that supports demand and inflation. So this chart shows the level of excess savings from beginning of 2020 during the pandemic, and the excess savings is slowly being spent down, but there is still a lot of it, over $1 trillion. That means the Fed is going to continue to having to raise rates to get inflation under control, because US consumers still have money and are still spending. So last week we talked about the US personal consumption expenditure inflation numbers. And if we look at those further, this is a trimmed version of the PCE deflator, and it shows that it's still rising. We have broad inflation in the US. So if we look at supply chain indices, on the left we have the Baltic Exchange Panamax index of international shipping, and that is well down from its highs and back towards norms. And the long distance trucking index is starting to come off, having absolutely shot through the moon during the pandemic. And supply chain bottlenecks have disappeared. So the number of ships waiting outside the ports of Los Angeles and Long Beach are back to normal. So what we're seeing is supply chain difficulties disappearing, and therefore goods inflation should also be fading. And last month, US house prices fell by the most in a decade, but frankly, that is not very much. They fell by much less than 1%. And bear in mind, we've had inflation of well over 20%. The persistence of US inflation means that Goldman Sachs are forecasting that US interest rates will peak between 4.5% and 4.75% next year. Turning to the EU, so this is Italian producer price inflation, and that's hit 50.5%. When I get a chance, when markets calm down, I've got several sections prepared on the Eurozone, and European companies are facing a big squeeze on their profit margins, and this is evidence of that. Now, pause, take a look at this. Here is a list of 14 reasons why US inflation rates should be starting to fall in the coming months. Now, what is missing from this list, which is all about goods inflation, is wages. As soon as wages start to fade, then inflation will also start to fade. So in summary, inflation in the EU continues to rise and shows absolutely no sign of slowing. Inflation in the US appears to be in the process of peaking, but CPI has not fallen as quickly as expected, as inflationary pressures have broadened, as evidenced by the persistence of inflation in the core CPI numbers. But in the coming months, as the US economy slows, so you'd expect US inflation to slow. Okay, on to recession watch. So if we dig further into the US jobs report of 2 weeks ago, so if we dig below the surface, there are some indications that the US jobs market is not as strong as the headline numbers portrayed. US households are stressed, and one of the reasons that the jobs number was so strong was that there are now more multiple job holders. So financially stressed workers are taking on more than one job, and that is not a sign of a healthy economy. And full-time jobs actually fell while part-time jobs rose, which indicates that companies are more uncertain about the future and less willing to take on full-time staff. And the average hourly weeks worked declined, though only slightly. So this is the US Conference Board's leading indicator, and it is now forecasting a recession because the US has suffered a big rate rise and energy shock. And you see from this chart, the gray vertical lines are US recessions, and they often tend to follow spikes in rates and energy. And US consumers are turning to their credit cards to fund borrowing. Now, we know that US consumers have savings, excess savings from the pandemic, but that is unevenly spread, and the poorer households will have already spent through those savings and are turning to their credit cards. And we showed you earlier the US 30-year mortgage rate, which continues to rise. And pause, take a look. This tweet shows the impact on housing affordability of those rate rises. If you secured a 30-year fixed mortgage on a $600,000 home at a 2.6% interest rate in 2021, you have the same monthly mortgage payment as someone that just bought a $392,000 home at today's 6.2% interest rate. And US mortgage rates have continued to rise from there. And now turning to Germany, the black line is the IFO Business Expectations Index, and the red line is GDP. And if the historic correlation holds, you can expect to see a very sharp contraction in German GDP over the coming months. Based on the IFO Business Expectation Index, the coming recession could be at least as bad as the one that followed the great financial crisis. And refinancing costs in Europe are rising sharply and are now the most expensive they've been in the past 25 years, although still only 2.5%. But as we talked about last week in the context of the UK gilts market, what matters is the speed with which interest rates rise, because during the good times when European corporates were able to borrow at very low rates, they raised a lot of debt. And now the sharp increase in refinancing costs is going to put a lot of heavily indebted European corporates under financial stress when they come to refinance. And an overview of the US. So this is US manufacturing and non-manufacturing PMIs. So this is the manufacturing PMIs. The blue line is the official number. The red line is the market's numbers. And these are the non-manufacturing PMIs. And there is some divergence there between the official numbers and the market numbers. The market numbers showing that non-manufacturing is now in contraction. We look at US junk bonds, and the bond market is always meant to be much smarter than the equity market. Well, the bond market is telling you that US corporates are in trouble. And turning to Europe, well, one of the big stories of the week on Twitter was the continued sell-off in the share price of Credit Suisse and the rise in price of its credit default swaps. Now, Credit Suisse is a huge, opaque Swiss bank, and nobody knows quite what's inside it. So we are expecting rising rates and an imminent global recession to cause a lot of financial stress. Who will be the first victim? It is impossible to know what the correct price of Credit Suisse is, but Credit Suisse is too big to fail. And these are the GDP forecasts for Europe from Goldman Sachs. And these are the GDP forecasts for Europe from Bloomberg Economics. And under all forecasts, the EU economy is forecast to slow, but there are scenarios in which the slowdown is really quite sharp and bad, with a fall of over 4% of GDP by Q1 2023. And evidence that the German economy is slowing can be seen in the unemployment numbers. So for 4 months now, we've had rising unemployment in Germany. Now, this chart shows the balance sheet of the big four central banks, and they are shrinking. Now, you know that last week, the Bank of England intervened in gilt markets to ensure financial stability, but it actually didn't have to buy many gilts. And it has reiterated that it is going to fulfill its intention to shrink its balance sheet by 80 billion by the end of the year. So the Fed and the Bank of England are committed to QT, and that will have the effect of reducing market liquidity and further tightening rates. Now, this is the NDR, Global Recession Probability Model, and it's at 98%. So they are very confident we're heading into a global recession. One line summary: global economy continues to slow, and we are heading into an energy crisis in Europe. Be careful. Onto the Euro, and on that note, onto the European energy crisis. So the chart on the left shows the size of European government energy subsidies. Vertical axis shows the size of the allocated funding. The horizontal axis shows the percentage of GDP. So obviously the largest economy, Germany, is spending the most money, but in percentage terms, Greece and Italy are spending the most. And as we know, they have the most debt and the highest funding costs. So how are they going to fund that fiscal largesse? Is the ECB going to buy their bonds? We could yet see a crisis in the Eurozone during this winter. Now, the EU had set a target for having gas storage levels at 80% by the beginning of October, and they're actually at 87.7%. So that's great news. But we know that some countries, such as Germany, will not be able to get through the winter without rationing, even if they start the winter with 100% gas storage levels, because the normal flows from Russia will not appear, and there's not enough gas storage to allow them to support normal gas consumption during the winter months without Russian gas flows. And this is European gas flows, and you can see that despite increased LNG, total gas flows are well down since February or from October last year. So bottom line, Europe is not getting as much gas as it needs. So this chart shows European gas storage levels throughout the winter based on different demand forecasts. And we now know that there will be no gas flows through Nord Stream because it's been blown up by somebody, probably the Russians. So if EU gas consumption remains as normal, we're looking at the bottom yellow and green lines, and by March next year, the EU could run out of gas, which means they would not be able to keep the lights on. So in order for that not to occur, there needs to be some demand destruction. And lots of European governments have now announced energy subsidy schemes, which will have the effect of supporting energy demand. So how will they achieve demand destruction? Will there have to be some rationing? And this is French nuclear energy output. And during the summer months, a lot of French nuclear power stations had to be closed down for maintenance, with cracks being found in the pipes. Well, the red line shows French nuclear power output, and it is well below normal. So we're going into the winter period with less French nuclear electricity than usual. And is Mother Nature going to be kind? Well, we're starting off October with a cold snap, and European temperatures are below normal. And sadly, the omens aren't good, because German gas consumption leapt the moment the cold snap started and is now 14.5% above the 5-year seasonal average. So much for calls for consumers to reduce their demand. And the FT is saying that long-term forecasts for this winter are of a colder than average winter with less wind and rain. So that's a very bad combination. So in conclusion, we're now in autumn. How we get through this winter will depend in part on the weather. and we can just wait and see whether Mother Nature is going to be kind. But having now acted to support consumers, European countries now will face the question of how they're going to cut demand. Will that include rationing? Okay, so now on to the US. Now, we've seen that the US JOLTS job report came in very weak, and there's been a strong rally in risk markets as the markets seem to have taken the weak JOLTS job openings report as an indication that the US economy is weak and the Fed will not have to raise rates as much as they'd previously thought, which supports equities. Are those hopes justified? Let's look at some real-time US economic indicators. This is US air travel, which is picking up. We're looking at the red line. Movie sales are really poor, but that's also a function of what films are on offer. Perhaps it's just a very weak year for new openings. The US hotel occupancy rate is better than average over the period 2000 to 2020. So hotel occupancy has fully recovered. Gasoline supply has bounced back. It is below 2019 levels, but it is not deteriorating. Credit card spending looks good. No signs of deterioration. Initial jobless claims are falling, indicating a strong labor market. Hotel room demand for the first full week after Labor Day was the highest it's ever been. And airfares are rising again to a new seasonal high. So that's all good news, but data for Q3 shows that apartment demand is now falling. So high rents are putting people off renting an apartment. And rental prices are falling, although only by a bit in September. All that post-Labor Day activity adds up to a very strong bounce in the Atlanta Fed GDP Now Q3 GDP estimate, which is now at 2.5% annualized. So in summary, the US economy looks okay. There are few indications from the real-time consumer spending reports that we've just looked through that demand is slowing. We are seeing slowdowns from the business sector, from manufacturing PMIs, but there's nothing in the real-time data we've seen to suggest the Fed should slow its pace of rate rises. And that is bad for risk assets such as equities and corporate bonds, and it's good for the US dollar as US rates can be expected to continue rising. Okay, on to QE. So what is QE? Well, QE is when the central bank prints a lot of money and uses it to buy equities and bonds from banks. So the banks, instead of having bonds and equities, have cash, and the central bank has a load of equities and bonds on its balance sheet. So why did central banks do QE? Well, the main aim was to try and lower long-term interest rates, but they also hoped to stimulate the economy by giving the banks more cash which they could lend out. And if the banks lent out that money, they would increase the money supply, increase inflation, and lower the exchange rate because inflation would be higher. And they expected all of that to lead to stronger growth. However, that's not really what happened. So the chart here shows the level of reserves held at the Fed on behalf of US banks. You'll see that after the great financial crisis, the reserves held at the Fed exploded. Now, what happened during the financial crisis was that the Fed started paying interest on overnight deposits. And so banks discovered that they could make money risk-free by lending to the Fed rather than risking it and lending it to the real economy. And during QE, when the Fed was giving them more money, instead of lending it out to the real economy, they simply parked it with the Fed. And so none of the aims of QE were realized. Part of the reason that banks didn't lend out the money were regulatory changes during the Great Financial Crisis, which required them to increase the amount of capital they held, lower their leverage, and fully disclose any off-balance sheet vehicles they had, such as SPVs, all of which made them more risk averse and more inclined to just park the money with the Fed. And many thanks to our Discord member, Wayne J, for sending me a load of information that helped me put this whole QE section together. Now, this is the interest rate paid on reserves held at the Fed, and you see interest rate has risen sharply in the US, and that means US banks can make good money just leaving their reserves with the Fed rather than lending it out. And this is the interest rate pre-pandemic, and you see during the pandemic, it essentially fell to zero. Now, one other thing I should mention is that lending to the Fed has a zero risk weighting for banks. So they don't have to put aside any reserves when lending to the Fed. And that makes it more attractive. So when considering lending to the private sector, they're only going to do so if the loans command a decent premium over the Fed rate. As the Fed rate is quite high, their loans to the private sector are going to be quite expensive, and that's bad for the economy. This is the amount of deposits held by the Fed over time, and you see they currently have 3.3 trillion on deposit there. What were the side effects of QE? So the central banks bought government bonds, and one of the aims of QE was to lower interest rates and stimulate the economy. But if they were successful in stimulating the economy, then they would increase credit demand, which would raise interest rates, which would raise bond yields, and cause the price of bonds to fall, including the bonds they held on their books. So they would then have mark-to-market losses on the bond portfolio they had bought using QE. So losses for the central bank were a known and accepted side effect of QE. And again, thank you to Wayne J for sending me this. This is the net profit and loss on the Bank of England's QE program. And as interest rates have risen sharply, so the Bank of England has swung rapidly into loss. And over the coming year, its losses are estimated to be around £34 billion. Now, over the past decade, the Treasury has received about 124 billion in total from the Bank of England in dividends, but the Bank of England's losses on its outstanding gilt portfolio are now estimated to be 200 billion. So its cumulative losses now exceed its cumulative profits from QE. When the Bank of England started QE, it received an indemnity from the government over any losses that it sustained through its bond buying program. So ultimately, the Treasury is on the hook for the losses. Other central banks around the world are facing similar problems. So the Reserve Bank of Australia has announced that due to losses on its QE portfolio, it is now in negative equity. In essence, it's bust. But all that means is it will cease paying dividends to the Australian Treasury until it's rebuilt its balance sheet and returned to positive equity. Reminder, central banks make money on seigniorage and also on interest on payments from their QE holdings, amongst other things. Now, what is seigniorage? Well, seigniorage is the difference between the value of notes and coinage and how much it costs to produce. So if you think of a £50 note, it costs what? 25p to make, and you sell it for 50 quid. So that £49.75 is profit to the Bank of England. So what are the implications of all this? What are the implications of central banks losing money and going bust? Well, they're going to need to be recapitalized. And that can happen either via governments issuing new debt and giving money to the central bank, or central banks halting dividends to the government and rebuilding their balance sheet, as Australia has done. But all that means is that the fiscal pressures facing governments are rising. They can no longer expect to get dividends from central banks. In fact, the flows may end up going the other way around. And if we think about the long-term impact of QE, over the past decade, during QE, central banks paid billions in dividends on their QE holdings and made capital gains on their bank and on their bond holdings. But now, all those profits are revealed to have been illusory. All that QE did was to move interest payments forward in time. So during QE, governments paid lower interest costs on their debt. Now they're going to have to pay higher interest costs. QE, in essence, was time transformation of interest payments. It didn't reduce them, just pushed them forward in time. So one line summary is that now we're doing QT, governments are no longer going to be receiving dividends from their central banks. They're going to have to subsidize them. And that adds to the fiscal pressures that governments around the world will be facing. So what are the long-term implications? Well, as the UK government has found out, markets are concerned about fiscal sustainability. So governments will have to commit themselves to putting their finances on a stable footing in the medium term. That means they'll need to either raise taxes or cut expenditure. The exception to that, of course, is Japan, where they're continuing to monetize the debt through perpetual QE, in which case the downside will be higher inflation. But accepting higher inflation means that you then have to change central bank mandates, and central bank loses all credibility, interest rates rise, and you face a solvency crisis. Okay, and on to credit default swaps. Now, this week, we've had an explosion in European CDS rates, with a lot of it concentrated on Credit Suisse, whose CDS has risen to levels last seen during the pandemic and prior to that during the Great Financial Crisis. This is chart showing the price to book ratios of Credit Suisse and Deutsche Bank. Now, we're heading into an energy crisis, which will place a great deal of stress on European corporates, which will lead to defaults and stress in the European banking system, and the market is worried. Now, this is Credit Suisse 5-year CDS, and the market is particularly worried about Credit Suisse. So, in summary, there are a lot of sources of stress on the financial system. We've got market volatility, rising interest rates, rising US dollar, and a slowing economy. And something will break. In these circumstances, something has always broken. We just don't know what it will be. So all we can do is wait and see, but be cautious about taking too much risk until the worst is over. And moving on to the S&P. Now, we've had a very strong rally in the S&P over the past few days. Is that just a function of liquidity? And I saw this tweet which claims to show that there's a very strong correlation between changes in the Fed balance sheet and the S&P 500. And that over the past couple of days, the reason for the big rise in the S&P 500 was that the Fed balance sheet reduced by 196 billion, which ended up in equity markets. And if this tweet is to be believed, the Fed's actions on Monday were intentional. They were concerned about what had happened in the UK gilt market previous week, and they acted to pump money into the market and stabilize the treasury market. Now, if we look at the charts contained in the original tweet, the blue line is the 1 week changes in the S&P 500, and the green line is 1 week changes in Fed net liquidity. And you'll see there is very good correlation between the two. Now, how is net liquidity defined? Well, it's defined as the total assets held by the Fed minus the Treasury General Account, which is money owed to the government or owned by the government, and the reverse repo facility, which is money owned by banks. And the important point is that in coming months, the Fed balance sheet is going to continue to shrink as a result of QT. So if we believe that the level of the S&P is merely a function of Fed net liquidity, then net liquidity is going to continue to drop. We should expect the S&P 500 to continue to drop in the coming months. So I have done my own version of the net liquidity formula, and this chart shows it in blue, daily changes, and the orange line is the S&P 500. So if we look at the daily data, there is a good correlation between the two, but that correlation really only starts in late 2020 when the Fed was doing a lot of QE. Now remember that the Fed's assets are bonds and its liabilities are cash. So reverse repo liabilities constitute bonds that it has purchased off the banks, and in return it has given them cash. And what this relationship, this correlation essentially is saying is that that cash which the Fed gave them as a result of reverse repo liabilities has ended up in the stock market. And as the Fed shrinks its balance sheet and sells those bonds back to banks, so in order to fund those purchases from the Fed, banks need to sell the equities they had previously bought. So shrinking Fed balance sheet equals sales of equities equals a falling stock market. And other people have calculated the correlation between the S&P 500 and net liquidity over the last couple of years, and it's got an R squared of 89%, i.e. net liquidity can explain 89% of the variation in the S&P 500, which is astonishingly high. If you think about the implications of that, that means that earnings don't matter, the economy doesn't matter, interest rates don't matter. What matters is net liquidity. Is that credible? And the assumption then is that the only thing that matters is changes in liquidity. Reminder, central bank balance sheet is going to continue shrinking. So if we believe this relationship, as long as the Fed is tightening and doing QE, the S&P 500 will continue to fall. Okay, on to other charts. Right, this is a really important chart for people living in the UK. So this is from the Halifax, and it shows mortgage payments as a percentage of take-home pay. And the grey line at the bottom is average mortgage payments over the period since 1983. And in Q2 2022, it was at 35%. So the average UK mortgage holder was paying around 35% of their income on their mortgage. Now, if interest rates rise to 4.95%, which is what the current Lloyd's TSB 2-year fixed rate is, then homeowners are going to end up paying 48% of their income on their mortgage. That is an enormous rise. So a third more going into an energy crisis and a cost of living crisis, where we know average wages have failed to keep up with inflation. So this is going to put more stress on UK consumers. Now, last week we saw chaos in the UK gilts market. Well, if we look at liquidity in the US Treasury market, conditions are also terrible. So global financial markets are currently seeing this combination of high volatility and low liquidity. And that is a nasty one that tends to lead to further volatility and blow-ups of some kind or another. Now, last week, essentially, the Bank of England had to intervene to prevent complete dysfunction in the UK gilts market. Is that a harbinger of things to come? Okay, on to equities. Well, it was a good week. The all share was up 1.4%, stocks Europe up 3.1%. The S&P 500 was up 4.1%, but bear in mind, this is being recorded before the US Open today, whereas the UK market has fallen the best part of 1% today. Bitcoin had a bounce up 2.6%. Sterling has been very volatile, but is now higher than before the mini budget. It was up 2.1% over the last few days. Euro was up 1.1%. The dollar suffered in the general risk-on environment and fell 1%, but is still up 16% on the year. So this is the S&P 500, which had a very strong bounce. This is the NASDAQ. Dollar index fell sharply. And is it any coincidence that hedge funds and asset managers were really short the S&P 500? And so the pain trade was a sharp rally in equities. But this year has been a terrible one for personal wealth. You see, the fall in global stocks and bonds has wiped out $35 trillion over the past year in people's wealth. And what's really interesting is finally, US retail investors have started to sell. So we know, we've been talking for many weeks now about how, when surveyed, investors were quite pessimistic about the future of the equity market, but they continued to be overweight. Well, now they've actually started doing something about it, and that could presage further falls in equity markets over the coming weeks if that persists. But if we look at this table, which shows the asset allocation of institutional investors, it shows institutional investors remain overweight equities. In the average bear market, they hold between around 38% of their assets in cash. It's now 22%, and they're overweight stocks. So if institutional investors follow their usual pattern of trying to increase cash going into a bear market, they need to do a lot more selling. And if we turn to US corporate earnings forecasts, well, the light blue and red line is EPS forecasts, and the dark blue line is CEO confidence. And you'll see historically there's been a very good correlation between the two. But right now, CEOs are very pessimistic and the market is optimistic about corporate earnings. I think US corporate earnings estimates are about to be revised lower, which will be bad for equity markets. And reminder that every bear market sees a lot of rallies, some of them quite sharp. So this is the bear market between 2000 and 2003. Pause and take a look if you're interested. But there were quite a few bear market rallies before the bottom. This one here, 19% rise, 21%, 21%, 21%. So there were 4 bear market rallies of around 20% in a bear market which saw a total fall of well over 30%. And this is the great financial crisis. And again, you see several very sharp bear market rallies. The big one here, almost 25%. One-line summary of my views. Don't fight the Fed. The Fed is doing QE and it's tightening still. Equities and risk assets have further to fall. So onto commodities. And if we take an overview of the commodity capex cycle, you are here. Capex is really low despite very high commodity prices over much of the last year, fading now. So the high commodity prices last year have failed to incentivize any increase in capex. So when the next cycle starts, there's going to be a shortage of new projects. That means it's likely to be short and sharp. Any increase in the economy will lead to an increase in demand for commodities, and the supply won't be there. So I fully intend to buy back into commodity stocks at the bottom of this cycle, but we're some way from the bottom yet. Onto energy commodities. So Brent and WTI had a good bounce on the back of the news from OPEC, and they're well up on the year. Dutch natural gas actually fell 18% over the course of the last 4 days. Not sure what's going on there. UK natural gas rose. So very volatile prices for gas in Europe. US natural gas futures drifted off slightly. Coal fell sharply, but is still up 138% on the year. Uranium was flat. There's no new data for the oil market. So this is Brent. And if we look at the Permian Basin, which is the one shale patch which still has a lot of spare capacity and room to grow, this is the productivity per well. And you see that wells continue to get more productive, in part because they're drilling longer laterals. So we know that productivity per foot of lateral has now peaked, but per well, it's still rising. This is European purchases of Russian crude, and the EU is close to agreeing an agreement on price caps for Russian crude, but in the meantime, they have cut their consumption. Whether their price cap will be effective or not is very much an open question. We know there's been a lot of cheating with countries in the Middle East buying Russian crude, processing it, and then selling the processed crude back to Europe, or blending it with their own and selling it back to Europe. So There's lots of sanctions busting at the moment, but direct shipments from Russia have been falling. This is EU natural gas futures that come off sharply over the past week, but still well up on last year, and winter's just starting. This is UK natural gas futures, US coal still very elevated, uranium going nowhere. Okay, on to industrial commodities, and what is really noticeable is that industrial commodities have largely failed to participate in the risk-on rally of the last week. The only exception is aluminium, which bounced sharply up 6.6%, but is still down 17% on the year. Iron ore continued to drift off, down 3%. Tin continued to drift off, down 48% on the year. Some charts. Aluminium showing a sharp bounce. Cobalt flat. Copper going nowhere. Chromium continuing its slow decline. Iron ore at the bottom of its recent range. Lithium at the top of its recent range, and there's a shortage of lithium. Neodymium flat. Nickel flat. Tin continuing to drift off. Ferrovanadium, has that found a bottom yet? Zinc, little bounce. Okay, on to precious metals. Well, precious metals are behaving like risk assets. Gold bounced 2%. Silver bounced an enormous 6.9%. Platinum up 4.7%. Palladium up 3.7%. Gold, silver, and platinum all still well down on the year in US dollar terms. Palladium, which is 46% of global palladium supply comes from Russia. So it is the one precious metal whose price has risen strongly this year. This is the gold price. Silver, nice bounce, but fading already. Platinum, rhodium, flat. Palladium, is that? Richard would say that's in a steadily rising channel. And finally, rates. Well, the Bank of England intervened in the market last week to calm the rise in UK gilt yields, but they remain elevated. So the 2-year has come down just 13 basis points in the last few days. The long end have continued rising. So the 20-year rose by 14 basis points to a new high of 4.26%. The 50-year is too low. It's at 3.66%, well below the 20-year, but it's catching up 34 basis points in the last few days. In Europe, both the Greek and Italian bond yields fell slightly. Let's show you some charts. So this chart shows liquidity conditions for German and Italian bonds. And as the ECB steps back from buying Italian bonds, so liquidity for Italian bonds is collapsing. And we know from the chart we showed you earlier that the Italian government has announced a very generous energy subsidy scheme. So where's it going to get the money from? This winter could be interesting. This is the UK 10-year gilt, and it's come off from its peak, but it's still massively up from before the mini budget. Now, reminder, we live in a globalized economy, and US Treasuries now appear to be the risk-free rate for the globe. So UK gilts are trading at a premium to US Treasuries, and UK mortgages must trade at a premium to UK gilts. So if you think about it, banks can get a risk-free return by lending to the government. If they want to lend to consumers, they have to get a decent premium above the gilt yield. And that is the best part of 4%. So based on that premise, UK mortgage rates will have risen by well over 50 basis points since the mini budget. So government ineptitude will have cost every mortgage holder in the country at least 50 basis points in their interest rate. And as the average UK mortgage is £138,000, that means it's going to have cost them something of the order of £700 a year in interest payments. This is the UK 30-year. Bank of England intervened and it has fallen sharply from its extraordinary peaks, but it is rising again. This is the US 10-year, and having fallen sharply on risk off, it has now bounced and is rising again. This is the German 10-year, similar pattern. Italian, similar pattern. Greek, similar pattern. We're in the seasonality charts. Well, reminder, October is generally a bad and volatile month for equities, although obviously this October we've started quite well. So concluding comments. During the last few days, we've seen a very strong bear market rally. And we showed you charts earlier showing that every bear market has some sharp rallies, and I don't expect this one to last. So be careful about taking on any risk. Okay, onto my own portfolio. Well, I had a poor week. I was down 1.8%. FTSE All Share bounced and was up 1.4%. So relative to FTSE, I had a pretty terrible week, down 3.2%. But for the year, I'm still up 21.6% and doing very well. And I did do a little bit of tinkering. I continued to add duration. So I sold some of the 1 to 3 year US Treasury ETF, and I bought a bit of the 20-year plus. This is my asset allocation. Now, on the Discord last week, when sterling was having its bout of extreme volatility, we had a discussion about the appropriateness of my asset allocation. And you'll know that I'm about 95% in US dollars. So all of which is in either US long bonds or US short bonds. Now, and JB was berating me for having a lack of risk control. And he's right. This is not a sensible asset allocation and is not one I recommend anyone take. But now I've been doing this a long time and I know my own risk appetite, which is quite high, frankly. So I aim to follow my convictions with big asset allocations. A wiser strategy would be to a well-diversified one. So don't hold all your assets in any one currency. Have some of it in US dollars by all means. And I continue to believe that the US dollar will appreciate over the coming months of the energy crisis. And I currently have no intention of cutting my big US dollar allocation. But it's been a volatile week for my portfolio, which has been rather disguised by the points at which I have reported my P&L. Last Monday, when sterling went through the floor, I had a fantastic P&L. I think I was up about 4% in 2 days, but that has all unwound, sadly, and I'm back to actually below where I started a couple of weeks ago because US long bonds have continued to sell off. But there you go. Okay, so that's it for this week. Thank you very much for watching. Normal service will resume next week when I am back from running the Chicago Marathon, hopefully. And Richard and I will be recording next Friday. In the meantime, please can you press like and subscribe to the channel. And it is goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.